I think that it's very likely that inflation, wherever it settles in, will be higher than what we experienced since the GFC. I think the disinflationary trend is likely over. And for however many decades we got, the runoff from the fall of the Berlin Wall, China entering the global economy. Hopefully I'm not politically triggering anyone, but Roe v. Wade, a lot of women entered the workforce on a global basis. So that, that made the labor force go up. And that's a good thing in terms of pricing. It brings pricing down. Kind of now sort of going in the other direction on a number of those fronts. I think there's a strong argument that could be made that globalization, this multi-decade trend, probably somewhere around 2013, 2014, the Arab Spring, kind of stopped or paused or bottomed or something like that. Follow on to Brexit in 2016, along with a number of other European countries that were looking to leave as well. And now greater interest in unionization. So these trends kind of point more towards a less globalized environment. The Russia-Ukraine situation, I would certainly say that prior to that, so in late 2021, I was very much of the opinion, even after the Fed shifted, that inflation was transitory. But once Russia-Ukraine occurred, and it became very obvious that there was sort of a new regime that was moving forward, I think that does push us more into a regionalized economy. You're almost within weeks, as soon as really Russia got cut out of the SWIFT system, you started seeing them establishing other methods for transacting, particularly with Asia. Effectively their revenues from oil have effectively gone through the roof. We saw oil then go to $120 per barrel. So there is a regime change afoot. And I think that COVID probably set the stage for it. It likely would have taken maybe 5 or 10 or maybe even longer for these things to play out, of course, in some other fashion. But the combination of COVID, zero COVID policy in China, Russia, Ukraine, all kind of point towards a more regionalized global economy, I think.
Is a more regionalized global economy inflationary?
I think
by its nature.
I think that it is relative to where we were. And, a great example is this idea of businesses moving from just in time to just in case, where there's a bit of a rush for goods. You don't know if you can secure raw materials. If I'm a mid-cap US company and I'm producing products in Southeast Asia, and I'm not really sure what's going to happen now that the EU is stepping in to potentially make Russian exports uninsurable. How does that impact my supply chain? Do I actually need to worry about hiring a security force to go alongside my tank container cargo of whatever it may be, of wares? I think that all those things point to higher costs.
So let's dive into the energy aspect for a while. So the COVID situation, the war in Ukraine, both expose vulnerabilities, right? But they're not. We don't know yet whether they're structural, right? It's sort of a geopolitical influence that seems to be over us, but highlighting what may have been an unsustainably stretched, very, very fragile supply chain. When it comes to energy, we've got the sort of geopolitical factors, which we can't even use the word transitory because it's just so maligned now and so misunderstood and kind of ruined by the whole debate with the Fed. But you, on top of that, have these sort of years of underinvestment that the commodity bulls point to as like, listen, even if there was a resolution in the situation with Ukraine, even if we took some pressure off of the demand side or the strains, you've got this years of underinvestment that are going to kind of put a permanently higher floor under where prices can go. So they're either going to be sky high or they're going to drift back if the geopolitical pressures ease, but they're never going to drift back that much because we just don't have that now. Do you see it that way, and how significant is that?
Yeah, I think Pandora's out of the box on the energy situation, and everybody has come to the realization that it's more fragile than anybody realized. Certainly Europe is realizing that right now. I think the US is in a really unique position, really because of the shale revolution. So again, in the 1970s, 73 and 78, there were the commodity shocks. Everybody thinks about lines to the gas station, things of that nature. At the time, energy imports as a percent of consumption were like 20%. They actually peaked in 2007. So it got better and then it got worse throughout the period of disinflation. But, again, this was the period of globalization. So the Berlin Wall fell. China was just emerging, the Asian tigers, supply chains were really, really moving around the globe. We peaked in 2007. The US, I think at the time, was producing maybe around 5 million barrels per day of oil equivalent. Now it's 11. So the US actually now is energy independent. When you look at net imports as a percent of consumption, it's actually negative, which is to say that we export technically more than we import. Now, of course, this is another one of those things that can change with regulation. We have the ability to sort of, shoot ourselves in the foot if we want to. Hopefully that doesn't happen. But the situation is very, very different for us, whereas Europe, again, as an example, is just so highly reliant or was highly reliant on cheap Russian energy. I think that, countries like Japan as well, a huge exporting economy. Germany, obviously, is, you'll probably start hearing the term the sick man of Europe coming back again about Germany because of what's happening with their current account. So I do think it's here to stay. I think that it's really hard to put Pandora back in the box on the energy situation. And what's actually going to exacerbate it is really what we've seen in the last few weeks with natural gas. So I don't think a lot of people realize the energy market. So they basically price on the marginal barrel of oil or unit of natural gas or whatever it is, which is to say that small producers are actually really, really important to the global price of energy. And so the derivatives markets actually relative to the physical markets are pretty small. Like if you go look at NYMEX crude oil outstanding, open interest outstanding, it's kind of in the 120 billion range. We're talking about a market that does trillions of dollars a year in revenue. If you're in an environment where rates are going up and the cost of capital is going up, that means that it's a little bit more difficult to be a trading partner that's not a commercial producer. And you saw this in sort of some of the statements from Equinor last week of this idea of this huge margin call that exists in the energy space of $1.5 trillion. So the worst thing that can happen really to the global economy, because financial conditions are so tied to financial markets, is that we get a bidless market in multiple different asset classes. I'm not saying any of that's going to happen. It's kind of like,
well, it sort of happened last week, though, didn't it?
Kind of happened.
In the electric.
In the natural gas market, in the electric market in Europe, where we saw these massive, massive spikes, which are effectively players being thrown out. The term in the industry for it is degrossing. There's too much risk, so they need to get risk off their books, so they are price insensitive and they get out wherever they can. So this is why you have, I think, the European regulators and politicians like getting their arms around this of, well, we don't want to support energy trading companies. What are you talking about? But this is the trend that's existed over the last several decades of we have moved to a services-based, fully financialized economy. So even though this causes so much angst when compared to Main Street and the American worker or the European worker or whatever it is, they're incredibly important. And you can't just make these decisions in a crisis situation based on these principles. It's regulation that needs to be made very thoughtfully over the course of decades, not sort of in the middle of a crisis. So the reason that I bring all this up is I think that fewer players within these markets will cause physical prices to gradually drift higher if we move into some sort of a situation where it becomes more regionalized overall. So you kind of have to look at all these.
That's really, really interesting. I just want to sort of stop and underscore that, because so if you weren't following closely, I think most of us were, but if you weren't following closely what happened in Northern Europe with nat gas and energy. So you're saying that we can almost you're calling it the financialization, which I think is right, but we could think of it also like in a kind of digital way. So you don't have people running around in some open market, like buying barrels of stuff from people and exchanging currency. This is all being done sort of virtually, and there are energy trading firms that are the conduit, right? They are the ones who set the price through derivative markets and sort of grease the system to make it work. And when you're in a highly risky environment right now, players drop out. So in a regionalized, we saw it through the intense situation with the crisis because of Russia and Ukraine. What can happen, which is what happened last week. The government had to come in and backstop them. But you're saying in a regionalized economy now, you're not going to be all connected globally, so therefore you will have less players, and just the cost of doing that is going to be naturally higher.
I think so. Yeah.
That makes a lot. That's very, very interesting, and it makes some sense if based on the test case we just saw.
At the very least, even if it doesn't result in higher costs, it will require innovation on the part of the major players in almost every market, consumer markets, energy markets, financial markets. And this is what happens at regime changes. I sit on an investment committee, and we really worry about sort of investing for the last 10 years and whether or not we're still doing that versus investing for what's going to happen over the next 10, because it's so incredibly difficult because of hindsight bias and anchoring and all the behavioral biases that exist. But every piece of data that you look at says that the next 10 years are going to be very, very different than the last 10 years.
Because regionalization seems like going back to something that existed before globalization, but the problem is you're not going back to those exact circumstances, right? Like you are not going to go back to exchanging barrels of stuff with different currencies and, whatever antiquated way they used to do it before. It's going to require something new. The system we now have doesn't work well in high-risk situations. In highly volatile situations, we found out there are strains, just like the supply chain, where the financial mechanisms don't always work. So something new is going to have to be created in order to sustain that.
Exactly. It'll be some new system that reaches an equilibrium. Whenever you see volatility in any market, all it is price looking for an equilibrium, whatever that is. And sometimes it takes years to figure it out. Sometimes it takes decades. But I think that ultimately over the next whatever period of time, 10 years, whatever, to your point, it's not going to go back to the way that it was in the 1950s or, right, pre-Bretton Woods or whatever it is. It'll be something different.
Hey there, revolutionaries. To join a community sharing insights like you just watched, head over to realvision.com. There you will get unbiased insights and exclusive access to the very best, brightest, and biggest names in finance. Be a part of our community of lifelong learners. See you there.